Brent, very good to see you. We're starting with a big question today. Are you tax ready for retirement? I know you have this conversation all the time because, of course, taxes don't disappear in retirement as much as we would like them to. In fact, understanding tax implications becomes even more important. So let's talk through the 4 tax questions that you should ask your advisor before retiring. And the first one is, how will my tax situation change once I retire?
Yeah, chances are it will change. And of the 5 worlds, taxes is one of the big ones. And so it's important to understand that, yeah, your taxes may go down, but it still needs to be taken into account. A lot of times I hear people say, what do you mean I have to pay taxes on Social Security and all of that stuff?
Right?
So it's very important to educate and then calculate that stuff and then set up withholdings correctly so you don't have a tax issue down the road. And that's
Yeah.
all discussed during setting up the income plan.
So many people assume their taxes are going to be lower in retirement, but often it's not.
Mhm.
So then the follow-up question, are there strategies to reduce my tax liability in retirement?
Absolutely. And that's why looking at the plan is so important when we decide where we're going to pull money from. So different buckets are taxed at different amounts. And we're going to talk a little bit about that a little bit later on. But it's important to make sure you draw correctly. And it's the way to pay the IRS the least amount of taxes possible. Another good way is to, you're probably about to get to it, is Roth conversions.
Right.
So what that is, essentially taking a taxable asset, turning it into a tax-free asset. And that's going to give you the ability to have another bucket to draw from tax-free in retirement.
And this is so important, Brent, because we are living in historically low tax rates right now.
Yeah, nobody likes taxes. I mean, I get it, but taxes are required. And if you look at over history, we are actually in a very historically low time for taxes. So Roth conversions is kind of the buzzword nowadays. And so everybody wants to talk about it. And it's good to talk about it right now because tax rates are not guaranteed to be this low in the future.
No, absolutely not. In fact, they are scheduled to go up on the last day of 2025.
Absolutely. You got it.
So then a lot of people wonder, should I consider a Roth conversion before I stop working?
Great question. Essentially, I like to convert up to the 22% tax bracket, maybe the 24% tax bracket. So it's going to depend on the income that they have. But one nice thing about doing conversions while you're still working is you still have the cash flow from your employer. So you can pay some of those taxes instead of using your IRA to pay those taxes. You can use your cash flow to pay those taxes. That's going to set you up for a better situation in retirement.
And then last, Brent, you touched on this a second ago. It does come down to your withdrawal strategy. What are the tax implications of withdrawing from my various accounts? And we ask because a lot of us good savers have so much money in these tax-deferred 401ks.
Correct. That's the number one thing I see is big pre-tax balances.
Yeah.
Draw strategy is just as important as how your investments are allocated. It really is important. It's because you've got a couple different buckets if you planned and saved right that you can pull money from to live on, buy new cars, travel, all those good things. This is a nice little visual that breaks down the 3 big ones. You've got the best bucket, which is tax-free. So I see a few municipal bonds out there, but it's mostly in the form of cash and Roth IRAs. When you take money out of this bucket, you don't owe the government a dime. The next best is taxable accounts. Think brokerage accounts, trusts, things like that. You owe taxes on dividends and interest, and then you also owe capital gains, but the principal has you've already paid the taxes on that. So it may make sense to pull some from here as well. Lastly is tax deferred. The government let people put money in pre-tax. It grew, tax deferred all these years. They are going to finally want their taxes. So you can pull from that bucket, but it is going to generate ordinary income tax rates. What's very important and was not shown on there, but I want to hit is Social Security. Social Security is not taxable for everyone. It depends on what buckets you're drawing from. So it's important to put a plan in place, especially if somebody has flexibility with these 3 buckets where we can try to reduce or remove the taxation from the Social Security.
The point is when you have tax diversification, it gives you more control over your tax liability. This was really helpful, Brent, and I think it's an important question that a lot of people might not consider before they retire. So if somebody wants to talk through these questions with you, what's the best way to reach you?
Yep, young-wm.com, or they can also go to or call the office at 614-430-8383. And the last thought I will give is everybody wants to talk about their investments. What am I going to be invested in? How am I going to make money? When it comes down to it, in my opinion, income planning is the biggest thing we can do for somebody.
You're right. Really important. Brent, thank you.
Thanks.